Okay, so chapter 6, we're gonna kind of uh, stay focused on merchandising businesses, but we're gonna now kind of uh, double click on one particular aspect of what we were doing in chapter 5, and it's gonna relate to how we do the accounting for inventory. Okay, so um, there are certain, and this is kind of review. We're going to talk about some of the accounting principles, and this is kind of just it does relate to what we're doing in this chapter, but I think it's just a good refresher on we I think we covered these in chapter 1, so just to remind you of some of the important accounting principles and like kind of what they mean. And again, the goal is that you're going to keep these principles in mind and see how they're playing into the different rules for the different kinds of accounting topics that we're going to cover. Okay, so we're going to talk about some of those principles. Um, this is kind of the main part of the chapter is these inventory costing methods. So what they are, why they're important, we're going to talk about that. Um, and related to that, we're going to see that depending on what method you choose, and again, this is an instance where you can have same transactions happening, but your choice of accounting method is going to change the financial statement. So we saw this in a couple things with like cash versus accrual basis. Um, I think we've seen it. I can't think of any others off the top of my head, but you have some choice in your accounting method, and based on that choice, and again, there's no right or wrong answer, uh, but based on that choice, you're going to change what your financial statements say. So we're going to talk about how the choice of this inventory costing method will change your financial statements. Um, we had the idea of shrinkage. What was shrinkage? Does anyone want to help me? You just did chapter 5, so hopefully you remember. Yeah, Mohammed. Yeah, it was a way of calculating or like taking a loss for theft, damage, errors. Um, we have kind of another instance of this where something goes wrong with your inventory, but this time it's not like it's lost or stolen. It's just it loses value, right? Like let's say you were, the Apple store and you bought a bunch of iPhone 4s back in the day, and you still have those in inventory. Do you think they're worth the same now as they were back whenever they first came out? No. So inventory oftentimes loses value. Okay, so we're going to talk about how to account for that. Um, This is kind of a minor topic. If there's an error in your inventory accounting, how that affects kind of your financial statements, and how it kind of self-corrects. We'll see that. And then, so we talked about in a merchandising business, we had the gross margin was one lever that the business can pull for earning a profit, which is we saw the luxury retailer, right? Their gross margin was very high, meaning they buy for one price and they're able to sell whatever it is, clothes, furniture, for a much higher price than what they paid for it. What was the other lever that we talked about? Does anyone remember? You can either, yeah, turnover, right? In the example of the banana, you can either sell, if you're buying the banana for $1, if you sell it for $5, that's a big gross margin. But maybe you're not going to sell that many because no one's going to pay $5 for a banana. So though you could sell one and make a big gross margin, maybe the better option is to price it for $1.50 and just sell way more of them. So even though you're making a much smaller margin, you're selling many more of them. And that turnover is going to result in a higher profit. Okay, so we'll talk about the measure of how to calculate that inventory turnover. Okay, so that's kind of the other part of merchandising business. Okay. Okay. Any questions on this so far? No. Okay. Okay. So the principles that again we've mentioned these, so let's just review. Um, Consistency. Okay. So this first one has to do with uh, applying the same procedures and the same methods across periods. Okay. Uh, what happens if we don't do that? What do you think would happen? Anyone have an opinion? What about Rin? What do you think? It wouldn't necessarily unbalance. It would make it difficult to compare different periods. Okay, if you're changing the rules every period, then you can't really look one versus the other because they're all based on different kind of methods. Okay, so we want to be consistently applying the same methods and procedures from period to period, and it allows us to better compare. Okay, so uh, consistency. Okay, what about disclosure? So disclosure means that your business has to disclose enough information about what you're doing, what methods you're using, what's going on with your business, what accounting assumptions you're using, so that uh, whoever is reading your financial statements, they can make an informed decision. Okay. Now, this can also be abused. Okay. So Enron, which was a big financial scandal, they actually disclosed kind of some of the shit. They in within their financial statements, they had stated what they were doing that was shady. Okay, so it was just so obscure and it was so hidden. It was like they kind of buried. It's like what is it called? Flooding the zone. Okay, I think this is what with social media and all that. They had flooded the zone. Okay, they had put so much information in their disclosures that the material thing that mattered, these kind of uh, the accounting tricks that they were doing, they had done some very aggressive accounting. It was hidden. It was like it was kind of buried, and you'd have to really beforehand kind of know where to find it because if you didn't know, is it's going to be hard to discern what they were actually saying. Okay, so disclosure, there's some balance too. Companies can use disclosure as a way of kind of flooding the zone and like bearing what they're actually doing. Okay, so maybe if we have time, I can, we can talk about Enron. They did some very, very, very aggressive things um, that were actually allowed under GAAP. Some of it. Um, so yeah, maybe if we have time later, we can talk about that. Um, okay, materiality. Uh, it's not practical for a business to report everything down to the exact dollar. And oftentimes it's not even possible because you're going to be using assumptions, right? For like how much people are going to bring back for warranties. We're going to learn about some of these assumptions. Um, or like in the next, or I guess chapter 8, we'll learn about with receivables. You're going to assume what percentage of them are going to like not pay you, right? Some of your customers may not end up paying that receivable. They may go out of business or just say screw you and not pay you. Um, but that's going to be based on an assumption. So there's a lot of things that we're going to start seeing, especially in the next several chapters, that are built on assuming things. Even depreciation, we already saw that, right? You assumed a certain uh, useful life. You assumed how much the residual value was, right? These are just assumptions that you're making. They're not actually necessarily going to work out, right? So a lot of things in accounting are built on assumptions, and so it's again not practical or possible to get everything to be exact. So what the materiality principle wants you to do is just uh, make things materially correct, meaning that uh, they should be close enough such that someone that's reading the financial statements wouldn't change their mind. Like, let's say you were looking at Amazon, and they have hundreds of millions or billions of dollars of inventory. If they were $10,000 off or $50,000 off, it's not going to matter because it's such a small percentage of their inventory. But if you were running a little convenience store and you were $50,000 off, it would be material, right? So materiality is going to depend on the size of the company. Okay, so yeah, I guess the principle here is you're not expected to be perfect, but you're expected to be materially accurate. Okay, and then conservatism. This is one I think we've talked about several times. In general, you want to underpromise as per U.S. GAAP. You never want to overstate assets or equity. Okay, so whenever you have a discrepancy between two different ways of valuing an asset, you're going to always choose the lower one. Okay, or if you're trying to say, have I earned this revenue or not? You're going to err on the side of not recognizing it if it's ambiguous. Okay, or if there's an expense and you're not sure if it's incurred or not, you would incur the expense because that's going to lower your equity. You don't want to not include an expense that should be. Okay, so again, you don't want to overstate assets, so you want to avoid assets being too high, or you don't want equity to be too high. Okay, so those are the two things that conservatism is trying to achieve. Okay, yeah. So and I think we talked about this, like R&D. That's like a classic example of conservatism, where it could be argued that R&D gives you future benefit and should be an asset, right? And you should kind of amortize it over time. But U.S. GAAP is conservative, and so we expense all R&D expenses, research and development expenses. Okay. Okay. Any questions on this? Any clarifications? Anyone confused about anything here? No? Yeah. Yeah. So look, how do you overstate equity, right? How is equity going to be overstated? Um, Contributed capital is really just a fixed amount, like it's your investors are going to give you some amount of money and they're going to get shares. So that there's no real risk here. Okay, contributed capital. But within retained earnings, there's revenues minus expenses. Dividends, that's also kind of a fixed amount, so there's no real risk there. The risk is that you're going to recognize a revenue that you didn't actually earn, right? So in order to avoid this being too high, equity being too high, you don't want revenue to be overstated. Okay? And the same thing with expense. If you have an expense that should be, but you don't include it, that's also going to end up overstating equity, right? Because this is a minus sign. So any expense is going to cause equity to go down. So you're more willing to do that. So if an expense is ambiguous, you want to recognize it. If a revenue is ambiguous, you don't want to recognize it. Make sense? Okay. Okay. So now just switching back to this inventory. Um, what are some, and we mentioned these, I think, what are some vulnerabilities related to inventory that a business has to manage? What are things that can happen to inventory that uh, a business needs to think about having some controls over? What do you think? Yeah. 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 So theft. So what do businesses do to manage that? Higher security. What else? Surveillance. Yeah, they budget for it. What else? What do a lot like in San Francisco? No one's gone to like a Walgreens in San Francisco. They lock it up, right? Even at like Walmart, Target, now like toothpaste, you can't just go there. You got to find someone to open up the thing, and so this is all theft prevention. Okay, and that costs them money. Okay, they're probably losing some sales. Um, they have to maybe have more staff. I don't know if Walmart will actually hire more people, but they're probably, it's a cost them to buy the containers, to have someone install them. It was all an expense to prevent theft. Exactly. Yeah. So there's an interesting thing about Trader Joe's. Okay, Trader Joe's leaves those refrigerators and their freezers open. Has anyone noticed this? Does this seem efficient use of energy? It doesn't. It's like, especially the freezer section. Okay, you go to that freezer aisle, everything is just open, right? And that is extremely, extremely costly from an energy perspective. But in their mind, it's worth it because you don't have to slide the door, and it makes actually shopping there much easier, and they can fit more people into the frozen section aisle. Okay, so this is an intentional thing that Trader Joe's has done, to make their inventory, these products more accessible. But it costs them money. They're paying probably way more in just electricity bills to keep those freezers running. Yeah. Yeah, exactly. Yes, Trader Joe's is trying to maximize turnover. They're trying to also minimize the square footage that they need for their stores, because rent is per square foot. Um, and so they're trying to have a more compact footprint to fit more items per square foot of retail space. So yeah, there's a lot of reasons that they're doing that. But yeah, a lot of it is just convenience too for the customer, and they can just be in and out faster. Okay. So what else? What about what other things related to inventory does a business have to manage? Yeah. Yeah, damaged goods. You have to figure out a way to deal with uh, goods that come back, right? Restock them. What about when they buy from either a wholesaler or a manufacturer? Does it just go straight to the store? Yeah. But where do they usually do that? Exactly, like a warehouse or something, right? So they need to have controls in place to receive inventory, right? They need to check that it's actually what they ordered from their vendor. They need to make sure the quantity is correct, right? Um, they need to make sure those warehouse employees are not stealing, right? Because it's not just consumers stealing, employees steal too. Okay, so this is a very this area of a business's operations is very in what we call internal controls intensive. There's a lot of things that are in place to manage inventory. Okay, so some things that we mentioned, and we can just re-emphasize here. So again, the reason that we have inventory controls are to prevent fraud and theft. We also want to avoid misstatements and inaccuracies. So you want to make sure your system is robust enough to like catch mistakes before they happen. Um, and just managing inventory, because like as we saw, this is money that your business is spending, right? This is like, when you steal some item from a store, it's like you're stealing cash from the register, because the business paid money for that inventory. Okay, so uh, the the better they can manage the inventory, the more efficient and the more profitable the business is going to be. Okay, so what are some areas? So ensuring inventory is purchased with proper authorization. So if some employee can just buy inventory on the company's account, what is the potential thing that could happen? Just think like a scammer. What would you do if you were a scammer? I'm not saying any of you are, but if you just had free access to your company's inventory ordering system, what could you do? And the accounting system, both. Yeah, what? Yeah, you just order yourself stuff, right? You just have it shipped to your house. Or you have it shipped to the warehouse, but you kind of bury the invoice, or like you get rid of the fact that it was paid for, and you just kind of take it to your house from there. Okay, so you want to make sure that things are bought with proper authorization. um, Tracking and documenting receipt of the inventory. So again, when the inventory comes in, you want to make sure that it's what you ordered, the quantity is what you ordered. So there's going to be some systems in place where the people at the warehouse have a kind of a receiving slip where they are told what to expect, and then they'll count and make sure it's all there. Or if it's different, they're going to report that. Recording damaged inventory properly. So we mentioned that. Um, this one has to do with shrinkage. We talked about this, where the accounting system and the physical amount of the stuff is going to differ because of all the various factors we talked about: theft, mistake, spoilage, damage. So you need to also have a physical count being done. So at some point, inventory is counted, and it's made sure that there's some reconciliation with the accounting system. And then when inventory is sold, how do businesses do this? How do they manage what's not theft, but like what's actually sold? What is the way that businesses track this? How do you go and pay for stuff? Yeah, they have barcodes, they scan it, so all the barcode scanning at the cash register, that is contributing to the company's inventory management system. They know exactly, they're tracking how many of those items have been stocked on the shelves, and they're also tracking who's buying, how many of them are leaving. Okay, so that then tells them, well, we need to order more. So every time you go and you pay for stuff and they're scanning those items, that's contributing to their inventory tracking system. Okay, because larger businesses have like a real-time inventory tracking. Okay, and that's useful for them because they know when they're running low on something, they'll order more. Okay, make sense? Okay, so we can watch a little, make this real. It's a little video on Amazon and their, inventory management system.
Pillow exists. So I almost made the dumbest mistake of my life. I got this contour pillow called Dorila.
You click there, and a box appears here. E-commerce is a magic trick that repeats millions of times a day. For a peek at what happens in between, we visited its inventor. This is where an Amazon delivery begins. A building that's 1/3 of a mile long. Ordinarily, it's off limits, but not today. Amazon opened closed doors.
Steady flow.
And opened my eyes.
I don't think it's well understood.
With a footprint equal to 59 football fields, this Amazon fulfillment center is simply mammoth.
We have the packing, the picking, the slamming, the shipping, the receiving.
It's home to an army of employees.
A little bit over 800.
One 6-ton pallet-slinging robot.
We affectionately call it Robo-Stow.
And a squad of box-shuffling cyborgs.
We like to think of it as a symphony between robots and our great associates.
We found a secret at our feet. The floor is covered in tiny QR codes.
It's sort of like a chessboard.
Eyes in the robots' bellies read the codes and broadcast their position. Choreography that keeps your shipment on time and avoids collisions.
They know exactly where to go.
Clicking that yellow button sets these robots in motion, sometimes within seconds. But your order is not handled by Android alone.
The drive units, the Amazon robots, are actually bringing items from where they're stored to associates so that associate can pick customer orders and get them ready to ship out.
A real-life human being boxes every Amazon order. As with every department, there's simply no guesswork in choosing the right box.
How do I know which box to pick?
Our technology will tell you.
The computer tells you.
The computer will tell us the perfect size box to fit that item.
From there, it's time to slam it.
Slam.
Fortunately, SLAM isn't an action. SLAM is an Amazon acronym for adding your address and sending your order home.
Scan, label, apply, manifest.
Orders are constant.
We process thousands and thousands of packages.
The exact number is confidential, but we do know that Amazon sales hit a record $88 billion in 2014, driven by new same-day delivery and selection that no other retailer can touch.
You can't fathom the amount of inventory that we have in the building.
It looks like a lot, and it is. Amazon says those shelves are home to 1 million different items.
1 million.
You think the typical customer realizes that?
Probably not.
We even spotted a toilet in stock.
You name it, we have it.
Chaos and a supersonic conveyor are what we expected. Manager Chris Monette explained that speed isn't everything.
The important thing is just the flow.
Order levels fluctuate, and yes, there are rush hours. Yet Amazon says its software regulates the line to maintain a steady pace.
In order to have 1 million unique items in this facility, you have to be able to do that.
As gaping, gargantuan, gigantic as this fulfillment center is, it's not alone.
We have 109 fulfillment centers worldwide.
Locally, 59 football fields probably isn't enough either. Our tour guides hinted at expansion. though they wouldn't touch the drone thing.
We did build this facility with room to grow, so stay tuned.
Amazon has taken heat for claims of harsh conditions at its warehouses. Perhaps that's why it granted us access behind the locked gates and let us interview Diane Ortiz.
I'm happy to have you guys.
She recently joined Amazon. Diane works 10-hour days, 4 days a week, is paid more than the national average, and disputes the company's critics.
I think they'll be in awe. Surprised, extremely surprised.
The other reason for our visit is you. This invitation is a rare opportunity to give shoppers an insider's view,
It's an awesome place to order.
to marvel at the robots,
We are very excited about the technology.
to admire the inventory,
1 million.
and to put a face on the company that, with the click of a button,
It takes more than that.
delivers A to Z.
And I love it.
Chris Camore, Fox 13 News.
Now, although Chris got a private tour there, the public can visit Amazon's fulfillment center as well. There are two catches, though. First, only select centers are open, and the closest to Tampa.
Okay, so this is almost 10 years ago. Okay, so you saw, what they were doing with the robots. It's probably way more automated. And let's see what the revenue is. So they said 88 billion. So now it's whatever, 720 billion. Okay, so in the last 10 years, it's gotten a lot bigger. Let's see though. That's this is not from yeah. So of that, 128 is from like their cloud, AWS. So it's still it's grown not quite 10x, but I don't know, 5 to 7x in their retail business. Okay, so that's so I think they had what I think you said 59 fulfillment centers. So it's going to be more than that now, and probably way more tech enabled. It's also interesting. Amazon had to kind of innovate because they don't call them warehouses; they call them fulfillment centers. Why do you think that is? What were warehouses doing for like other retailers? Any ideas? What? Exactly. They were just storage, and they were like a place where inventory came and then went out to be distributed to the stores. What Amazon did is the inventory comes in, but then at that same location, they're going to put it in the box, they're going to put the shipping label, and they're going to send it out to the customer. Right? So that is a whole logistical kind of they had to come up with that because there's no other warehouses doing that where they were fulfilling the orders right there. Okay, so that was a challenge in itself because you have to go through the inventory, pick out individual items of each thing with the orders and kind of put it into a box. And so it was it was a big business challenge for them to figure that out. Yeah. Yeah, I don't know. Probably not though. Yeah, I don't know if that's like a patentable thing. But yeah, maybe those robots, like the robot that actually goes along the path, maybe they have a patent on that. But yeah, now logistics is like e-commerce is in the last 10 years has grown, not just Amazon, but just in general. So there's other warehouse kind of operators that and fulfillment center operators that probably have similar kind of logistics now. But Amazon is definitely an innovator in this. Okay, any comments on this? Questions? Yeah, it is impressive. I agree. To grow from zero, I think they went public in '99, and they went public, not too long after they started. It is incredible that they're at the scale that they are. It's like some people get lucky. I feel like there's some billionaires that are like, especially like the finance hedge fund guys that are, I think they're kind of in a business that's very scalable to begin with. Like analyzing a stock to buy 10 shares is the same as buying 1,000,000 shares. But this is like a brick and mortar business, like you can't just scale this easily. This takes tremendous like planning and execution. And it's, Bezos deserves the credit that he gets. He really did build something amazing in one lifetime, less than a lifetime. Okay. And he actually became a billionaire not from Amazon. He was a seed stage investor in Google. He like met the founders when they were first starting, and he saw that the idea is so great. He invested in their original seed round, and that's how he actually became the first billion he made was from Google and not from Amazon. So I think he's a smart guy. There's you can read and listen to podcasts about Amazon. It's quite amazing what he did. Okay, so let's go back. Okay, so let's just talk about this idea of inventory costing. Okay, what is the problem that we're trying to figure out? Okay, so I'm going to give you a hypothetical here. Okay, so on January 5th, we bought 10 units at $5 each. Okay, so that's where this $50 is coming from. We would have done something like, inventory, debit $50, and then let's just say accounts payable. Okay, so that's where this debit is coming from. Everyone should be familiar with that from last chapter, purchase transaction. Everyone good with that? Okay, so then the next day, we're buying 8 more units. Okay, so at a different price. So we have $5 each unit here, $7 here. So this is a similar kind of thing. This is where the 56 comes from, right? 8 times 7 is $56. So that the total value of the purchase is $56. So now we have $106 of inventory. And then we have one more purchase transaction. We buy, now it's another price, $3. Okay, so that's where this 12 comes from. 4 units, $3 each, $12. So we have within this $118 kind of 3 layers. We have a $5 layer, we have a $7 layer, and a $3 layer. Okay, and there's 10 of these, there's 8 of these, and there's 4 of these. Okay, so now the next day we sell 12 units. Okay, so we know that one of our journal entries for this sales transaction is going to be of this form, right? Again, this should be clear from last chapter. We did this all day, right? The difference is in chapter 5, we were just told what the cost of goods sold is. Okay, now we're going to ask the question, okay, we're selling 12 units. We have a total of 22 units here. So how should we calculate cost of goods sold? We're selling 12. How much should we pay for those 12? What is the question that we have? To answer that, what do we need to know? Yeah.
You need to know to identify the system or to figure out which specific item we are selling and what cost is attached to it.
Exactly. Okay, so for example, our cost of goods sold could be, maybe we're going to sell 10 of these and 2 of these. So then we would do 50 plus 2 of these $3 units is 6. So it could be 56 where we had 10 from here. So we're going to sell all of these. And then this will go to 2 because 2 of them are going to be sold here. So there's 10 and there's 2. So there's 12 units at $56. Or we could do maybe, again, we have $5, 10. Oh man, I'm running out of space. Okay, I'll just do it in our heads, okay? Maybe we'll do 6 from this $5. So this 10 will become 4, and the cost of goods sold. Okay, so how should I draw this? Okay, so does everyone follow how I got this 56? Right? Again, I had 10 units at $5, and I'm going to sell 10 of them. That's going to be $50 of cost of goods sold. But I need 12 units So I need to take 2 more from over here. So I took 2. I had 4 originally. I crossed this out. I have 2 left, and 2 of them are going to be sold, and that cost me $6. So the total cost of goods sold is 56. Okay, I could also do, instead of 10 from this $5 bucket, I'm going to do 6. So 6 times 5 is $30. And then I can do 6 from here. Okay, so if I do 6 from here, 6 times 7 is 42. Okay, so now my cost of goods sold is 72. Okay, so the same 12 units, but I have 2 totally different costs of goods sold, just depending on which of these buckets I chose from. Okay, so we need some way of doing this because there's no right answer here. We just need to choose a method and stick to it. Okay, so this is kind of the problem that we're trying to solve with having an inventory costing method, because in the real world, we're not going to always pay the same price for our inventory. It's going to be fluctuating. Okay, so we need to have some way of choosing which units we're going to cost when we have a sales transaction. Okay. Okay, so before we continue with this is a little review, okay, on the accounting principles that we talked about. So see if you retain this. See if you can read these and remember what the name of the accounting principle was. Okay, so take a couple minutes, see if you can do that. Okay, the first one, a business should report the least favorable figures in the financial statement when multiple possibilities are presented in order to avoid overstating assets and equity. So what did we call that principle? Conservatism. Yes, good. Okay. A business's financial statements must report enough information for outsiders to make knowledgeable decisions about the company. What do we call this? Who wants to tell me with confidence? Yeah. Uh, kind of. I see what you're saying. It's not totally wrong. Yeah. Disclosure, right? Yeah. You want to make sure enough is known about the business, disclose enough so that they can know. But you're on the right track. Materiality, you could say, is part of that. Okay, a business should use the same accounting methods and procedures from period to period. Yeah, Scott. Consistency principle. Good. And then a company is not expected to be 100% accurate, but must be accurate enough such that any errors or misstatements would not change the decision of a rational and informed third party. That is materiality, right? Again, you're not expected to be perfect, but you should be materially accurate, right? Yeah? Everyone good with that? Okay. Thanks, Scott. The second one was disclosure principle. Okay, so back to this costing method. Okay, there are 4 costing methods that are acceptable under GAAP. Okay, we're going to talk about these in detail. FIFO stands for first in, first out. LIFO stands for last in, first out. Weighted average and specific identification. Okay, so these 4, it's kind of at the discretion of the company, and kind of for this one, it's also has to be like it's like this one is for like special situation. But these 3 are kind of at the discretion of the company. Okay, they can choose which one they want. And depending on that choice, you're going to get 3 different kind of effects on your, or like the outcome on your income statement and your balance sheet are going to be different depending on which one of these methods you choose. Even though you have the same number of units being sold and the same revenue, sales revenue, the way that you're going to calculate cost of goods sold is going to be different between these 3, and therefore your expenses will be different, and therefore your inventory will be different, and your profit will be different, because these are ways that we're calculating cost of goods sold. And we know that cost of goods sold and inventory are like one is changing from one to another. So if you change cost of goods sold, you're going to change inventory, and because those two accounts are kind of linked together. Okay, one key point is that the costing method is not the same as the physical flow of the units. Okay, in most cases, the actual physical unit flow is going to be first in, first out, and we'll talk about what these are. But usually, you want to get rid of your oldest inventory first. Okay, and that's kind of what first in, first out is. Okay, so again, this is just a way to get to a cost of goods sold. Really, we need to figure out a way for our accounting books to calculate cost of goods sold. And that's what this method is really for. The physical flow of things is going to be, it's going to be different depending on what the business is kind of, especially if it's like food, right? Food, you don't want to just keep stuff sitting on the shelf. So you're going to kind of try to sell the oldest stuff first, right? And I would say it's hard to think of any inventory where you wouldn't want to do that, even for the clothes or whatever, fashion, fashion goes out of fashion quick. So you probably want to sell, whatever inventory earlier. Yeah, probably. Income statement, balance sheet. Okay, so again, the choice of this is directly gonna affect cost of goods sold, right? That's gonna show up in your income statement. And because if you remember, our journal entry is cost of goods sold, debit, inventory, credit, this is gonna be a balance sheet account. So whatever we kind of choose to calculate this, it's also gonna affect inventory. Make sense? Okay. Okay, so specific identification. It's really for when you can, as the name implies, specifically identify each unit in your inventory. Okay, so how are automobiles? How are they identified? Uniquely. What is the unique identifier called? Yeah, the VIN number, right? Every car has its unique kind of ID called a VIN, right? Vehicle identification number. So you can if you had 1,000 cars, you can track them individually, and you actually know, especially for Toyota or these automakers that are very, very good about their inventory management. You even know the cost of that. You know the cost of that exact car. Okay, and so you can track them when that car sells. You can then see what that costs, what that car costs to make, and you can expense it exactly. Okay, uh, other things are easier, like jewelry. These are like individual pieces, so that's very easy to track, and they're kind of they're unique, you can say. So you can use this method because again, you know exactly which item you're selling, and you know how much you paid for it. Okay, so it's easy to do the matching of the revenue and the cost of goods sold. Art, again, no two pieces of art are exactly the same, so you can track those individually. Customized product. Real estate, no two pieces of real estate are exactly the same, even in a tract home. My parents live in a tract home kind of development, and I was just sitting in the backyard, and their backyard is open to this government land kind of. And so even though there's a house kind of across the street that looks like theirs, it's not the same because that land is different. And they have a better backyard, and it's just so every piece of real estate is uniquely identified. It's got a unique address, right? So it's easy to track the sale of real estate too because each one is unique. Okay, so again, if you can identify specifically which item is being sold, you also can track how much you paid for that unique item. And so you can exactly match your revenues and your cost of goods sold. So this is, again, a kind of niche costing method, but again, you have to be able to track each individual inventory item individually, right? It's not like Amazon where they have, 50 toilets, right? Because each of those toilets is not, you can't identify each toilet specifically. You only know that it's the same toilet, but the toilets are a kind of a commodity, so you can't really track them individually. So this has to be each individual item in your inventory has to be trackable. Because again, the toilets, it's kind of the same as this example that I was doing above here. These could have been bought 10 units of toilet, right, for some amount. So because I can't individually track these 10 toilets versus these, because they're all the same model of toilet, I can't really use specific identification because they're all different costs. Okay, so the key takeaway is that each individual item has to be trackable in order to use specific identification. Okay. Okay. I'm just gonna talk about what these are. I'll do one example, and then we'll probably spend the rest of the class just working together on doing this. Okay. So LIFO versus FIFO. LIFO is last in, first out. You can think about it as a stack. Okay. And how do you kind of cost the inventory? It's you just take whatever is on the top, right? And whatever comes in is going to go on top, and whatever is being sold is going to come off the top, right? So this is like you can think about it like a stack of boxes. You can think about it like if you're at the buffet, they stack, they have the dish thing, and you like the dishes on the bottom maybe never get used in 20 years, because the clean dishes they put on top, and then when people come, they take the dish right off the top. So there's a bunch of dishes at the bottom that maybe never get used up, right? Because it's just whatever comes on top gets used first. Okay, so you can visualize this however you want. It's also used in computer science, stacks versus heaps. I don't know if you guys, if that's like there's like this idea of like which one goes first there's a lot of real life kind of examples of this these methods showing up. Okay, so inventory costing, you can learn it. You might see these in different contexts in your business career. Okay, FIFO is kind of like a line of people. Okay, this person that's about to be served has been waiting the longest, right? This person in the back just got there. Okay, so it's like the oldest one goes first. Okay, so this is stack versus queue. Okay, the stack is LIFO, a line, a queue is FIFO. Okay, so keep these straight. However you're going to do it, each person is different, how you want to visualize it or think about it. But I think these are kind of helpful, a couple ways to think about it. You can also think about FIFO as like the milk at the grocery store. They put the oldest one in the back, and the one that's closest to you is like the oldest, or sorry, the newest one in the back. The one that's closest to you that you're pulling out is the oldest, right? Because they're trying to get rid of that first. Okay. So again, however you want to think about it. If we use LIFO as our costing method, the cost of goods sold is going to reflect the most recent price of our inventory, because as soon as we get inventory in, we're going to use that price as the cost of goods sold, because again, it's LIFO, right? So if let's say we paid $1 for these, $2 for these, 3, and then 4. We bought this most recently, but this is also going to come out as cost of goods sold. So this old one is just going to sit here lingering at $1. But that's good. I mean, you can argue it's good because cost of goods sold is going to be accurate as to what the current market is for that particular item I'm selling. Okay. The problem is though that inventory layers, these LIFO layers as they're called, your balance sheet is going to be wrong. Okay, because it's going to have these units that are at the bottom listed being worth $1, but they're actually worth something else because the more recent price has changed. So it's gonna create this distortion on your balance sheet. Okay, so that's the trade-off with LIFO, that you get more accurate cost of goods sold as per like the latest market for that item, but your balance sheet is going to be kind of messed up because it's going to have this old inventory with stale cost hanging out on the balance sheet. Okay. FIFO, it's kind of the opposite. Your inventory is based on the oldest inventory, but it's kind of refreshing all the time. So you don't get this like stagnation at the bottom. Okay. Because it's rare that a business will sell out all of its inventory, right? That's the only way under LIFO that this $1 inventory will get costed. They sold everything, and that's rare, right? FIFO keeps things a little fresher because this person in the back is eventually going to get to the front. Okay, while in LIFO, this bottom one can just stay at the bottom forever. Okay, make sense? Okay. Okay, so this is just a math question. Okay, we're going to talk about this last method. If you have 10 units at $5 each and 50 units at $70 each, is the average price of $6 for the 60 units? Does that make sense to use? Think about that. Think about it for a minute. Talk to your neighbor. Discuss if you think that that's fair. Because remember, how did I get $6? $5, $7. The average of 5 and 7 is $6. And then if you have an opinion on this, raise your hand if you want to advocate for your position. Think about it for a minute. Just a second. So you probably have the right answer, but I want to let people think about it. Okay, Scott was very enthusiastic. So Scott, what do you think?
Not.
Okay, why not?
When you have 10 units at 50, when you have 7 units for 50 units, that's 350, so that would be 400, which means you would more money, about $6.
Okay, you're doing the math in your head. Okay, so let's just unpack what Scott said. Okay, he's saying that you had 50 units at $7. So that value of that inventory is 350. And then you had 10 units at $5. And the value of this is $50. Agree? Do we agree with that? Okay, so if we add this up, it's $400. And how many units is this? 60. Okay, so what is this equal to? Is it gonna, how about this? Before we do the math, is it closer to 5 or is it closer to 7? Closer to 7, right? Because there's more $7 units. Okay, so what we just did here is basically calculate the weighted average. The average cost is just that, that the average price paid is $6. But we also have to factor in how many units of each of those there are to get the weighted average. Okay, so the way you do it is basically figure out the total value of the inventory divided by the total number of units. It's not more complicated than that. Okay, so what is this? Does anyone want to help me with the math? 6.66? 6.67? Okay, and as we estimated, it's closer to 7 because there's more $7 units. Okay, so this is the amount we'll use in weighted average to calculate our cost of goods sold. Okay, and we're only going to update this when we buy new inventory at a new cost. Okay, because that will change the weighted average. But until then, these 60 units, we can represent the value of them with one price. Okay, so this is actually, you can argue, the simplest method. You don't have to keep track of all the different layers, and you can just kind of average everything together. Okay, okay. So yeah, I think we kind of did it. But just to make sure everyone understands, the weighted average, the formula is the total value of the inventory divided by the total number of units. And again, this is going to cause the weighting to be towards the cost that has the most units. Okay, because that's going to kind of like skew the total value of the inventory. It's going to be weighed more heavily for whichever price has more units. Okay, so in this example, beginning inventory is 5,000. We bought 10 more units for 2,000. So how much was this per unit? If we bought 10 units for $2,000, what is the cost per unit that we paid? This is easy math. This is $200 per unit. Per unit. Okay, and if we started with 10 units, how much was this per unit? The beginning inventory, it's $500 per unit, right? In this case, we're actually going to get the average because we have the same weighing. The beginning number of units and the number we bought is the same. So it is actually just going to be the average of 500 and 200, which is 350. But again, if we had 100 units, it's gonna weigh depending on the number of units. So hopefully you see that, and you're gonna get practice with this. So, but in general, I think the easiest way to do the calculation, you just figure out the total value of the inventory. So in this case, it was 7,000 divided by the total number of units. Okay, and that will give you the weighted average. Okay, and it's gonna actually result in a middle ground between LIFO and FIFO. So LIFO and FIFO, we're gonna see kind of one will give you like the highest cost of goods sold. The big assumption here, though, is that, and I don't want to say highest because it depends on, like, let's assume what is the normal kind of direction that prices go? Up, right? What do we call that? Inflation, right? So if you assume that the price of whatever your inventory item is going up, which one is going to give you the higher, let's start with profit. Which one gives you the higher profit? LIFO or FIFO? What do you think? Why FIFO?
Because cost of goods sold gonna be smaller because it's a older price.
Yes,
So the smaller would be subject to sales revenues.
exactly.
Which would,
Exactly. Okay, so look, if we're assuming that prices are going up over time, LIFO is going to have a higher cost of goods sold because it's going to use those newer, higher dollar price items in inventory as your cost of goods sold. And if you have higher cost of goods sold, that's going to cause your profit to be lower because cost of goods sold is an expense. So a larger expense is going to result in a lower profit. Okay, and so the opposite will be true with FIFO. FIFO is going to give you the highest profit because it's using the oldest value of the inventory, and weighted average is going to be in between those two because it's not using the oldest or the highest, it's using a blend of the two. Okay, and it's the opposite with inventory. Okay, so if LIFO is going to give you the highest cost of goods sold, it's going to end up with the lowest inventory value. Okay, your balance sheet will show a lower amount of inventory than it is going to be under LIFO. Okay, so again, if your cost of goods is higher, that means inventory is going to be lower. If your cost of goods is lower, inventory is going to be higher because those two are again trading off between each other. Right? Yeah, Chris.
If FIFO results higher profit, then what advantages are there FIFO?
There are some businesses that will use FIFO for their financial reporting and LIFO for their tax reporting. What do you think the advantage is there? When you're calculating income tax, do you want to show more or less profit if you can? Yeah. So, or if you're a GM and you have to negotiate with your labor union, who is very attentive on how much profit you're making, maybe you want to understate it using a inventory costing method that is going to just lower it artificially. Or if you're fighting antitrust regulation, oh, I'm not that profitable, or I'm not as profitable as I could, So there's reasons why a business may want to show lower profit than they actually are making. Amazon has been doing this notoriously for a long time. You can see they haven't made a net profit for like a long time because they basically expense their growth and their R&D and stuff, So it kind of has given them long-term revenue growth, but their net income has not been that spectacular. So yeah, this is why like knowing these accounting rules is important too. Um, Yeah, and they don't. Yeah, I mean, they get around the taxes using other things. They incorporate in Ireland, and they do all these fancy like tax uh, transfers, basically. Um, Apple, I think, has Apple, Google, all these like tech companies. They're like notorious tax evaders, and it's not illegal. They're using legal loopholes to do this. Okay, so I'm going to show you kind of why don't we take a couple minutes break? I'm going to show you this spreadsheet, what we're going to be using to do the practice problems, and then we'll start it definitely today. So let's take a little break. Okay, so look, I'm going to be walking through examples of these calculations. I want to just point out that we're going to be using the exact same transactions, okay, for all the different methods. And you're going to see that they're going to result in different cost of goods sold, different inventory balances. Okay, just the only thing we're changing is the method of calculating cost of goods sold. Okay, the other thing to keep in mind is that the revenue side, because you can see here we're doing sales and purchase transactions. The revenue side is separate from this. Okay, the revenue is dependent on what we're selling to our customers for. So that is kind of independent of this calculation. This is just how we're calculating cost of goods sold. Okay, so we're not given enough information to do like the full journal entry for the sales transaction because we would need to know what we sold it for, right? We're only tracking right now what we're purchasing it for, or when we sell items. Okay, what we're going to cost it. Okay, so let's do the first one. So the first one, we're going to use specific identification. Okay, so we bought 4 units. Okay, so you can see here, we have, I guess, let's point out, we have a starting balance. So we have 2 units. The unit cost is $350, so the total value is $700. Okay, and of course, the math is 2 units times $350. And again, these are dollar amounts, so maybe I'll make that clear. Okay. This is just, I'm going to do an example, and then we're going to do like an actual problem. You guys will do that. Okay, so I'm just going to, yeah, this is not there. I'm just going to do this on the board quickly, and then we're going to do a problem together. Okay, so you bought 4 units, so the total cost is 4 times 365. So this is the amount I'm going to put in a journal entry, right? A purchase transaction. So we're going to debit 14,600, 14,600 credit, and we're going to get inventory here. Inventory. This is a purchase transaction. The costing method is not factoring into here, okay? The costing method only has to do with calculating cost of goods sold. The purchase transaction is straightforward. We just see how many units we bought, what the unit cost is, and that's what we're adding to inventory, okay? And I don't know, we can just do accounts payable, however we paid for it. Okay, so now what do we have in inventory? We have 2 units at 350, and then we have 4 units at 365. So this times this. So the total value of my inventory, again, these are all dollar amounts. Okay. So everyone see where I got this? Everyone's following? We have kind of like 2 layers of inventory now at these 2 different costs. Okay. So now is when the magic happens. We have a sales transaction. We're going to need cost of goods sold. So we're gonna not use this section. You can see is for purchases. This section is for cost of goods sold. So we're gonna be using this middle because it's a sales transaction. So we're selling 4. So I don't know. This can be, since we're able to track these 6 individually, there's 6 units here total. Maybe I'm selling 1 unit from this 350 and 3 units from the 365. Okay, this is one possibility. So it could be that our cost of goods sold. Let's just complete this assumption. Okay, so this 1,445, this would be used in my journal entry 1445, 1445, and so this is inventory. Sorry, cost of goods sold, inventory. So let me just keep a T account going here. In the T account, the thing it's missing is that it does not have any of the quantities. It's just going to be tracking the dollar amount totals. The extra advantage or why I have this table here is that I'm tracking the quantities and their respective unit prices. That's why we need this extra kind of information in the table here. Okay, but just for completeness or to show you the difference, so we had a starting balance of 700. Remember this? We had a purchase transaction right here, 1460, and now we have this sales transaction. So we have a credit. Okay, so as of now, if I were to just stop my transactions here, this plus this, oops, minus this. So let's just see what happens in our table. Okay, so I should expect to see after this transaction a value in my inventory of 715. So let's just verify that. Okay, so I've sold 4 units. They were of this kind of mix, right? So how many units of this 350 do I have? 1, right? So 1 at 350. And then how many of these 365 units? Also 1. Okay. So if I add these up, it does reconcile with my T account, right? So again, this table here is just more detail of my inventory, broken out by units and unit price. Okay, but the totals will reconcile with my T account because I'm tracking just like the totals in the T account. Okay, so they should always be matching up. Okay, so let's do the next one. So now we bought 12 units at 3. And again, this I could have done 2 and 2, right? And that would have changed the situation. See, now it's 1,430. If I sold this, I would have 0 of these and 2 of these. Okay, so you can see here it would have changed my cost of goods sold, right? So then it would have changed this to 1460, 1460, and then this would have been 1460, and it would have been or 1430. Yeah, sorry. Okay, so now you can see this 730 and this are also reconciled. Okay, so okay, so now let's just I guess let's just go with this. Let's say this was our specific identification. We were able to know exactly which 4 were sold. Okay, so now we're buying 12 more. So the total value of this purchase transaction is this. So again, we would kind of have the same journal entry here. And the value I could just kind of do a cell reference. Okay, so now 4, 6, 5, this. Okay, so that's the debit to inventory. And then in my detail, okay, I have 2 units of 365 and then 12 units at 380. So total of 14 units. And then and the total value is 5,290. Okay, and then I sold 10 units. Okay, so now again, we have some, since we're using specific identification, we're going to have to know exactly how much of each one. So maybe we sold 1 of the 365 and then 9 of the other one. And again, I know this because I'm tracking each unit individually. So I know where it came from, what bucket. Okay, this could have been 2 and 7 or 2 and 8, whatever it is. Or it could have been 0 and 10. Okay, so since we can track each one individually, we know what the distribution is. So I don't know, let's just assume 1 and 9. Okay, so the cost of goods sold is 3785. Cost of goods sold, inventory. Okay, and then I have credit, inventory. And then let's just do a final, what is my ending inventory balance? I have 1 of these 365 units left because I had 2 and I just sold 1. And I have 12 minus 9, which is 3 with the 380 ones. So my total value of inventory, okay, 1505. So let's just make sure that that's the case. So here, so I had this balance plus this debit minus this. So yes, it does reconcile. Okay. So again, all this whole exercise here is really to be able to calculate this and this. And once we calculate this and this, it's going to kind of affect my inventory balance because again, these two are related, right? Where from this inventory, we took some units out and whatever is left over is going to be my ending inventory. So whatever method we use for this, it's going to directly impact the ending inventory after the transaction, the value of it. Okay. All right. So now let's look at FIFO. Okay. So same purchase transaction, nothing different. Purchase transactions, again, are totally unaffected by our inventory costing method. So it's going to be this exact same journal entry. Okay, so the first transaction is the same. Now we sold 4. Now okay, so let's just make sure we're clear. 2 units at 350 was our starting balance. Now we have 4 units at 365. Okay, so we're selling 4 units. So again, we're now moving to this section because it's a cost of goods sold calculation. First in, first out. We're going to start with the oldest units, this oldest layer. Okay, we're going to take as many units as we can out of this. So we have 4 total that we sold. This layer only has 2, but we're just going to take all of them. We're going to cost those first. So 2 at 350. And then however more units we need, we're going to take from the next oldest layer. So since we only have 2, we're going to take 2 more from here. 2 at 365. Okay. So this is our cost of goods sold using FIFO. Hopefully, did I? I kind of inadvertently used FIFO here too. Okay, I didn't mean to. So kind of ignore that. Ignore this. It's actually this. The numbers are the same. You'll see the difference when we do the last sales transaction, though. Okay, so what do we have left? We have 2 units at 365 because we got rid of this layer. This is all sold. These are all gone. So we only have these the units left. Okay, so then we buy 12 more. And again, the purchase transactions are all the same. So this transaction here is the exact same in both scenarios. Okay, and now we're gonna, okay, so our ending inventory, again, we have 2 units at 365 that are carrying over. And then we have 12 more units at 380. Okay, so now we're gonna sell 10 units, okay? So again, we're gonna start at the back. These are the oldest ones. We're gonna expense those 2. And then we're going to move on. How many more units do we need from here if we're selling 10 total? 8 more, exactly. So 8 units. So we're 365. These are 380. Okay, so what do we have left over? Well, we have 0 units at 365. And we have 4 units at 380. Okay, so we can see we have different ending inventory balances, right? 1505 with specific identification, which is arbitrary. We were just kind of randomly picking units here. Okay. This one is different though, just by changing the method. Okay. Okay, and then let's just do LIFO. And so I'm not going to do this. I'm just going to kind of put in the values because I think we've seen it now a couple times. Okay, so that we're selling 4 units. 4 units are sold. Okay, so now instead of starting at the back like we did LIFO, we're going to start at the front. So we're going to cost these 4 units first. Okay, so our cost of goods sold is going to be 4 units at 365 for 1,460. And if you remember back under FIFO, we had 1,430. So we have a different cost of goods sold just by changing the method. We're still selling 4 units. We're just now using LIFO instead of FIFO. Okay, so then we would have, whatever, cost of goods sold this, but instead of 1430, it'd be 1460. Okay, and then we bought 12 more. So again, what do we have left? We have this 350. Basically, we still have our starting inventory. It's the same inventory and the same inventory cost. Okay, because again, the newest stuff that came in, we sold that first. And then here, after this purchase, we have 2 at 350, and then 12 at 380. And then finally, this 10 units sold. We're gonna again start at this layer. Okay, so we're gonna sell 10 units out of here. So that again, we'll keep this 350 layer is still lingering. This is what I'm saying. This thing can just hang out for a long time. Oops, sorry. 2, 350, and then 2, 380. Okay, so in all the cases, we have 4 units left. 4, 4, 4. Same number of units, but different value because we've been costing them differently. This one has 1505, this one is 1520, this one is 1460. Everyone see that? Everyone agrees? Same number of units, but the balance sheet is going to have different ending balance for inventory because the cost of goods sold has been different for each of them. Yeah, makes sense? Okay, and then weighted average. So now we have like kind of a calculation we're going to have to do. And the calculation is going to be redone after every purchase transaction. Okay, so the journal entry for this purchase transaction is the same though. Okay, this same amount of inventory is being purchased, $1,460. So this journal entry is the exact same as it's always been. Okay, now we're gonna buy 4 more. So we basically, what you can do is just count the total number of units. We started with 2. We're adding 4 more. We have 6 units total. You then start with the cost. $700 was the value of the original balance. Plus, I'm adding $14,060, right? So now my formula is this total cost divided by the number of units, 360. Okay? So this is, in one line, we're representing all of our inventory. We kind of did it backwards though, where we had the total cost and the number of units, and we just backed into the weighted average unit cost. Okay, so now we don't have to have the layers because now everything, all 6 of these units is represented by one weighted average cost. Okay, so now when we sell 4 units, it's very simple. 4 units, the weighted average cost is 360, and our cost of goods sold is just 4 times that, 14,400. So then we would basically do cost of goods sold, 14,400, 14,400. Okay, and now how many units do we have left in inventory? We had 6, we sold 4, we have 2 left, same weighted average cost. Okay, now we're buying 12 more. So again, the purchase transaction, that's when we have to trigger a recalculation of the weighted average cost because now we have a new cost basis, right? We have new inventory coming in at a different per unit cost. So we're gonna have to redo the calculation. So again, what you can do is just add up. We have 2 units. I'm adding 12 more. So I'll have 14 units. The total value is 720 plus this times this. Okay, and then I can figure out my unit cost is the total value divided by the number of units. So now it's like some weird number, 377 point something. Okay, but I can use this as my value going forward for my sales transaction. So when I sell 10 units, it's just using this one weighted average. I don't have to do any go from the back or the front or anything. It's just using that one number. Okay, and then we'll have 4 units left. And again, we'll always have 4 units left because the physical movement of goods is the same. I'm using the same transactions for all these. The only difference is the costing method has changed. So 4 units, here's my weighted average cost. This times this, 1508. Okay, so let's compare these 3. So, oops. So for FIFO, it was 15,020. For LIFO, it was 14,060. And for a weighted average is 1508. So FIFO was the highest. LIFO was the lowest, and weighted average was somewhere in the middle. Yeah. It did change, right? It changed from 360. First it was 350, the opening balance, then it changed to 360, and then it changed to 377. Yeah. And it only changes when you buy inventory, because that's when you have new inventory coming in at a different unit cost. Then you have to redo the calculation. The sales transactions, you just keep using that same weighted average, because all the units that you have in inventory is kind of valued at the same weighted average amount per unit. Okay, so that's a key thing to remember. Weighted average, you only recalculate it when you have a purchase transaction. Sales transactions, you just use the weighted average that you've already calculated. Okay, everyone clear on that? Yeah, well, we're going to find out because we're going to do a practice problem now. Okay, so go ahead, you can download the Excel sheet. No, I don't want it. And let's start with an example with the weighted average. It's the first tab, 6-3. And this one, you're going to be asked to do the journal entries, and it's giving you information also on the revenue. Okay, so you can do the full sales transaction. You can do the revenue, and I think it says you can assume cash. You know, you're selling them for cash. Okay, it's giving you information on the different unit costs, and it's telling you when the sales transactions happened, which bikes from which kind of bucket of costs were sold. Okay, so you'll have to use specific identification to kind of fill out this table and then do the journal entries, kind of like what I was doing on the board. Okay, so just read very carefully what they're asking, read the different values that they're giving you, and try to figure this out. Okay, and if you're getting stuck, raise your hand. I can try to come help you. I'll just to get you started, you can just say you have a starting balance, okay? And it's telling you that you have 12 bicycles at $42 each. So my starting balance is 12 at 42. And so my total inventory value is just $504, which is 12 times 42. Okay, and now you're going to have sales transaction here. You're going to have some purchase transactions, and you're just going to fill out this table and see if you can use the information in the table to then translate it to doing the journal entries. The journal entries are really the important thing. That's what's kind of changing your accounting system and is going to eventually translate into your financial statements. So this table here is kind of just to help you do that, okay, to keep track of the different inventory layers. Okay, all right, so go ahead and start that, see if you can figure it out. So look, we have our starting balance already. We already entered this in. We have one purchase transaction. So we're going to do August 16th is the date of the transaction. It's saying we're buying 40 bicycles at $68 each. So quantity 40, unit cost $68. And so the total cost, the total value of this purchase is $2,720. So just make these dollar amounts to make this clear. Okay, so now in our inventory, we have the original 12 at $42 each, which is worth $504. And then we have 40 more units at $68 each. Okay, so let's just be clear. We have a total of 52 units, and the total value of those 52 units is $3,224. Okay, So let's just do the journal entry for this August 16th. Okay, so August 16th, we're buying inventory, so merchandise inventory. It's going to be debited. And I don't know, we can assume accounts payable. Okay, just it doesn't explicitly tell us. Or actually does it? Let's see. Purchase. Yeah, so it says on account, so it's accounts payable. And the sale was also on account. Okay, so we just got the number from here. This is the total value of that purchase. Okay, so that's our journal entry for the first transaction. Any questions on this? Anyone confused on this? Yeah. Yeah, because it told you here, it is kind of hidden, but it says the merchandise inventory was on account, and also the sales transaction is on account. Okay, so now we have our last, there's only 2 transactions in this month, and it's saying that on August 31st, we sold 36 bicycles, and it was for $84 each. So actually, Luis, I told you something wrong. Your sales transaction is missing half. You did one part of it, but you didn't do the other part. Okay, so let's just do the cost of goods sold, and then we'll finish. We'll do the full journal entry. Okay, so it's saying that we sold 8 at 42 and 28 at 68. So 8 plus. Let's just be clear. We sold 36 total. 28 plus 8 is 36. So this is how we're accounting for those 36 units. Okay, 28 of them were from this bucket basically. So 28 were priced at $68 each. And then 8 of them are for $42 each. Okay, so the total of my cost of goods sold is $2,240. Okay, so what do I have left over? Let's just get our ending inventory balance. So we had 40 of these units. We sold 28 of them. That leaves 12 of these $68 units. And we started with 12 and we sold 8 of the $42 units. So we have 4 of those left. Okay, so the total value of the inventory ending balance is $984. Okay, so now let's do the journal entry. So now we have the cost of goods sold here. And it's also telling us how much we sold them for. We sold them for $84 each. Okay, so every sales transaction, again, has 2 journal entries. So let's do the revenue first. And it says they were sold on account, so they're account receivable and sales revenue. And it was 36 units, and we sold them for $84 each. Actually, you did have it, right? Was it? You did have the revenue. Okay. For the cost of goods sold, but for the revenue. Okay. Okay. All right, cool. Okay, so sales revenue. Everyone good with this? How we got this? Again, it was 36 bikes were sold for $84 each. Okay. Now we do the second journal entry, which is cost of goods sold and inventory. And I just calculated that right here. So I'll just cell reference this. Okay, so now let's just do our T account for inventory, just to make sure that we're correct and lined up with what we just calculated. So I had a starting balance of 504. That was the value of my inventory. Okay, and I had this purchase transaction, debit. And then I had this sales transaction, credit. Okay, so now let's find out what our balance is. And we see here that our ending balance of inventory is exactly the same as what we have here in our more detailed table. Okay, so that's your check to make sure you did this right. That this quantity on hand, the total value of the inventory, should be the same as your T account if you're just tracking the totals. Okay, where did people get lost on this? Or any clarifying questions? No, everyone got this? Okay, well, we're gonna get more practice on Wednesday where we'll take the same set of transactions and just apply different inventory costing methods. And so you're gonna get another crack at this if you didn't quite understand or need more practice. All right, so yeah, that's it. We'll meet up on Wednesday. Don't forget the DSM is due before class. You guys are here, so maybe you might want to show up on Wednesday too. Hint, hint. Okay.